In today's video, we will review how markets have performed over the last quarter, changes that we've made to portfolios for some of our clients over the last quarter, hopefully provide some historical perspective on things going on right now, and the keys to the market finding a bottom. As always, with these end of quarter videos, our clients may or may not have positions in any of the securities that I'm going to discuss today, as each investor's goals vary. If you'd like to discuss your specific positions, please don't hesitate to reach out. And if you are a client, you'll also be receiving a separate email detailing your specific individual portfolio performance. Also, I try to typically keep most of my videos on the shorter side of things, but obviously there's a ton going on right now and a lot to cover. So this one's going to be a little bit longer than normal. So here we can see various market metrics from Blackrock, ranging from oil to the broad equity markets in the US. The orange bar shows the year-to-date range in price in performance, and the yellow dots reflect where the market levels were as of last week on June 24th. There haven't been many places to hide this year, but that doesn't mean that there aren't still potential opportunities, really because of the amount of negative consumer sentiment weighing on all markets. At the end of the day, the only thing that the stock market cares about is future expected corporate earnings. And generally speaking, what we've experienced so far this year is a contraction in this future expectation. So on this chart, we can see the forward PE, or price to earnings ratio, back in January, peaking around 23 times earnings. At the end of May, the multiple was sitting around 17 on the S&P 500, with the long-term average near that same number. So what the market in a broad sense has done here is, with all the uncertainty out there, simply compress this multiple more in line with historical norms. So I see this and I wonder, all right, we've pulled back on the forward PE. How do markets typically perform going forward with the PE sitting around where we are now? So on the x-axis here, we have the forward PE, and on the y-axis, we have the subsequent one-year returns on the left and the 5-year annualized returns on the right since 1997. If we were to draw a line through this data, call it a ballpark average, what this tells us is that on average, the lower the forward PE, the higher the subsequent returns. So if we slide to the left on the x-axis and lower the PE, those subsequent returns on the y-axis tend to increase on average. So that's great to know, but what we're all wondering is, what will be the true drivers right now to the market finding a bottom? Well, there are three significant issues in my mind impacting markets right now. Number one, lockdowns in China. Just recently, China has begun to ease their zero COVID policy, with new infections under 100 a day for almost 2 weeks now. And while most lockdowns have been lifted, it's going to take a while for the supply constraints to work themselves out. The Russia-Ukraine conflict. This is obviously hurting growth in Europe and domestically and stoking both inflation and oil prices. And then number three, we have 40-year high inflation. Central banks are really facing a growth versus inflation trade-off. Hiking rates too much, risk triggering a recession while not tightening enough, risk causing runaway inflation. So the Fed has made it clear to the stock market that it's ready to literally intentionally dampen growth. Time will tell how much dampening is going to be required to stifle the inflation. Now, resolving these three key issues will be the key to the markets finding a bottom and restoring investor confidence. And any investor that can say with certainty how much worse it can get and when the selling will stop, in my mind, is only demonstrating their investment acumen, because really over the short run, markets are going to continue to be volatile. Instead, I think it's important to take a minute to zoom out and maintain perspective. So here we're looking at the worst years ever for the US stock market. The key is to focus on the 3 and 5 year columns. The average 3-year return is 35%, and if I average out the 5-year column, it's almost 80%. Remember, you don't get the high returns without the possibility of low returns on occasion. It's not a bug, it's a feature of the stock market. Peter Lynch has a famous quote, "Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves." The takeaway is this: stay in the game and stay the course. That said, we aren't sitting on our hands either. So let's shift now and review some of the tweaks and changes that we've made for some of our clients over the last quarter. Again, this is not intended as specific investment advice, as each investor, including our own clients, may or may not have positions in any of the securities discussed. Also, forewarning, this part of the video will be pretty heavy on the financial jargon, so please reach out if you'd like to discuss anything further. All right, so earlier this year, with the expectation of more persistent inflation, we proactively put on positions in commodities and in energy. And just a quick screen grab from Yahoo Finance here shows how COMT, broad-based commodity ETF in the dark blue, and XLE, a broad energy ETF in the light blue, have performed year to date. So for some clients, we were able to lock in portions of those gains during the last quarter and use those proceeds to introduce exposure to U.S. infrastructure and dividend-focused companies, which have historically delivered attractive relative returns during periods of tightened financial conditions. We also reduced overall sensitivity to growth in more volatile assets by cutting our net exposure to technology and small caps. So we were able to trim things there. Flipping over to the bond side of the portfolio, we increased the exposure to inflation-protected U.S. Treasuries, or TIPS as they're known, which potentially provides less downside if long nominal rates continue to rise, while providing a hedge against any future potential upside surprises, potentially in inflation. One final overall thing we've implemented is the future prospect for governments to continue on their net zero emissions climate journey. And politics aside, climate risk and subsequent legislative risk do translate to investment risk, regardless of your political beliefs, right? So I don't want to make this about politics. The market doesn't care if it's red or blue, just that it's green. And the narrowing window for many governments to reach their net zero goals means that investors could consider adapting their portfolios today. The net zero journey is not a 2050 story, it's a now story. And because of this, we favor equity sectors that are going to be better positioned for the green transition. Realize I covered a ton during this video in a very short amount of time. So for my clients, I also realize that many of you will be receiving quarterly performance reports with lackluster returns, to say the least. Please know that I'm keeping an eye on things and that I'm here if you want to talk. As always, stay the course, stay on point. Take care.